Hello and welcome to a brand new show of Market Makers. In this edition of Market Makers, we are coming to you from this wonderful University of Flame, one of the youngest university in India and perhaps the only university which promises to combine management and fine art together. My guest on the show is someone whom you've seen on previous occasions, on previous shows of Market Makers. He's an investor, both public and private, and he's also on the governing body of Flame University. Manish Chokhani. Manish, thank you for having us over. It's a wonderful campus.
Thanks for coming.
The unique edge of Flame as a university is fine art and management together. It rarely happens. Can it happen? Can it coexist?
Well, it's liberal arts, so fine arts is one element of it, but liberal arts and sciences is really the whole gamut of studies that one can do. And the way I like to introduce it is, if you think of the analogy between the old SSC system and the new IB system, where in the SSC system you would read, memorize, reproduce, and the IB system now introduces you to the whole array of subjects where you're planning, then you're doing the task, then you're reviewing it, and then you're doing the whole cycle again like a management student. So liberal arts is the way, of course, the US has built its whole education system, and we know why so many Indians now go there to study. The object being that you can first get the whole width of things, so you understand the world in its entirety rather than through a very narrow prism of science or arts or engineering. And then you can get depth. After you experience the width, you can get the depth, and you can go deeper into a particular field, and nothing prevents you from having a major in, as you said, management, and another minor in one of the psychology or political science or economics or something of that nature, which may be very different from your major. It just makes you a much more complete person, and it's really a good person who becomes a good investor, because then you have awareness of 360, what's going on in the world. And what we offer here, therefore, is a very immersive experience, as well as enough room for you to explore and grow as a person.
The good thing, I guess, perhaps about this university is that it's been backed by investors who know the art, who know the finesse, and who understand that what a great investor needs in order to differentiate. So is that an edge for this university?
So in all honesty, you use the word investors in plural. It's really the vision of our founder, Nimish Shah, who's endowed this university, and it's completely not for profit. And what we'd like to do is offer the whole experience of education which people try to get overseas in India itself. And the campus, as you see here, is comparable to anything else anywhere in the world, in the Ivy Leagues as well.
If I just run through the governing body of Flame University, some of the key speakers who've been there, some of the board members, they are mavericks, marquee investors, and they are successful people in their own strata. So in terms of experience, do you think in today's time it is a necessity to have a wider understanding? It is important that in today's environment you have to coexist in 2 or 3 brackets?
So absolutely. I mean, if you think, I'll give you 2 small examples. You think of today, if you grew up in the old system where you learned accounting, and you didn't know what was going on in China, and you didn't know what was going on in Brazil, and you didn't know what was going on in the US, it would make you a very poor entrepreneur, it would make you a very poor investor. So you do have to have that consciousness of what's happening around the world. Flip it to the next part, that if you only look at things from, say, a financial prism, you will never see the juxtaposition which is going on in the world today between, let's say, technology and design. I mean, take Apple as an example. It's a left brain, right brain combination which is coming together. If you were only a technologist, you would never have created an Apple. If you were only a design student, you would have never created an Apple. It's when you get these 2 faculties in together that you create something outstanding. If you think of the way people are now building out the new economy in the world, whether it's using the genome, whether it's using Elon Musk's new battery-powered cars, or indeed the new form of energy, it is various streams coming together, because life doesn't come neatly packaged as a physics problem, or as a biology problem, or as a design problem. It comes as a messy problem which we have to solve as entrepreneurs. And as investors, you have to have the pattern recognition to see what is going on and which field can give you an insight into what is going on over there. It was illustrated very beautifully by Charlie Munger, who's our guru as well, in his famous lecture where he talked of having mental models of every discipline, because that becomes part of your common sense. And what we're hoping to do by way of this sort of education is widen your common sense instead of just making it very narrow.
When I talk to people privately and publicly, the first recollection they have of Flame University is that a marquee investor is backing it.
Sure.
And is this a university for me to go so that I can learn how to be a great investor or a great financial wizard? But this university is not about that. It's just beyond that.
This university, any good investor first has to be a good human being.
Okay.
And he has to be a self-aware human being who knows what is happening in the world. Okay. A good investor, as Mr. Buffett says, is a good businessman, and a good businessman is a good investor. And I'd now venture to say that this is sort of stage 3 of our life, as you called it, Vanprastha, where you can give back. So if you're a good investor and you can't give back, are you a good investor? So it's that evolution of a human being, which really one would hope to create, a bunch of students coming out of here who can change the world. I'll give you a very small example of a person who is very respected in India, who came out of liberal arts and who actually, I think, did a film major, and that was Anand Mahindra. Now, you would never think of an industrialist as successful or with as much width of businesses which he now conducts, from engineering to finance to technology to what have you. Or even Ratan Tata, he came out of architecture school in Cornell and he ran the Tata Group. So, to slot people saying that because you have not got a business undergraduate degree, you will not be a good businessman or not a good investor is, I think, the old typecast, which that's really the shackles one is trying to break.
Sure, of course, it's a differentiated approach, the campus, and we would be exploring the campus. But just before we move on to the other segment and talk about other relevant
I just want to say a last thing. Also, our aspiration is not to create people looking for jobs. Our people is to create graduates from here who will create jobs.
But that's far-fetched.
So there will be leaders. It will happen.
Far-fetched.
It will happen. Like I said, a university is not built in a day. It didn't take Stanford 3 years to get built or Harvard 3 years to get built. They are 50, 150, 150-year-old institutions. We will get there. And with the resources we are able to bring to the table, we want to give it our best shot. We are not averse to picking up phones and calling corporates to, take students from here.
Rome was not built in one day. So let's take a quick break on this edition of Market Makers. When we come back, we'll explore the campus, we'll talk about markets, and with Manish Chokhani, it's always about investments. Welcome back. We are coming to you from this wonderful campus of Flame University. Manish, every time you come on the show, we have to talk markets. It's been stormy, it's been choppy for global markets. August was stormy. September was scary. So far, October has been solid. Do you think worst of the price sprint is over?
So the markets are, as I've been saying for the last 5-7 years, the world has been a really sick patient, and it's being brought out of its disease with the same cure which caused the disease. So it's not going to be solved in a hurry, and it is going to remain schizophrenic. So you will get these bouts of despair where you think things are going to blow up. So a 2% move in China changes the force of gravity, and you feel everything is going to go down the tubes, and I better sell and get out as quickly as I can. And then 4 weeks later, you'll get a response which says, let's print a lot more money and put it into the system. And you go back into euphoria that there's no rate cut, there's more liquidity coming, and let's celebrate again. So in these alternating bouts, to call it a bull market or a bear market is probably wrong. It's really a volatile, schizophrenic market. And until there's a reset in the world, probably through currencies, we will not really start a great expansionary cycle. Also, a lot of the action now, as we were speaking earlier, is happening outside the markets. Like we spoke briefly, this year private equity money into India is a multiple of the money which FIIs have brought in.
How much is that?
So this year we are on track to doing maybe 15-16 billion of inflows from the private equity industry.
That's 4 times the FI investment.
Currently 4 times of the FI investment. Although FIs at one time were 8 billion and then 4 has gone out. But what I'm saying is that the excitement, a lot of it has shifted outside the main markets. Because if you think of a lot of the wealth creation, whether it's in the US or in India, or indeed in China, it's been happening outside the so-called old economy companies. So for every Apple which is listed, there's an Uber in the private domain. In India, there may be an Ola, and stuff like that is going on. So there is serious money, and when people say the investment cycle hasn't revived, I sometimes smile, because 15 billion of equity money coming into India is, if that's not investment cycle, then what is?
It may not be hard infrastructure, but things
yeah,
are happening
so
on the ground.
if you think of it, the agricultural economy ended at a particular age, and the way China has built capacity for 60% of world, having 10 or 15% of world GDP, the age of manufacturing is probably in a deflationary environment. So it's
That's
a tough
because
period
there's excess
to
capacity in the world.
yeah. I mean, who in his right mind is going to put up a steel plant for the next 10 years?
For the longest time, we've always maintained that the India story has to be weaved around financials. We are underbanked,
Sure.
banks under-penetrated. Is that thesis still evolving, or are you still of the view that don't go to PSU banks, buy private banks? Digitization is happening there. Best of the banks now have got great apps.
Right. So it's the same old story that if we are a 2 trillion odd GDP economy and we save 25%, so we are saving about $500 billion a year.
Which will only go up.
Which is only going to go up. The GDP from 2 trillion is hopefully going to go to 5 or 6. I mean, China, when we started in 1990, was the same. Today, China is 10 trillion. It's 5x. So it says a lot for what we missed and the opportunities we missed along the way. But let's say we get to 5 trillion. Let's say we stay with a 40-50% saving rate. It's trillions of dollars of saving. Today, of the 500 billion, we are barely putting half into financial assets. It's going into real estate and gold, the other half.
But that reset has started already.
So that has already started. You're seeing flows into mutual funds, for example. You're seeing the whole move towards insurance, pensions, and all of that will happen. So this share, which is 50% of savings, will go higher and higher to financial savings, and the pot itself is growing. Within this pot, currently, the banking sector is 75% controlled by the public sector. Now, you don't have to be a genius to see that the share, which was 100, has eroded to 75 and is going to erode only more as we go ahead. Secondly, with the way banking is now done, I don't know when was the last time you went to your bank branch or you wrote a physical check. It is becoming more and more digital.
And private guys will gain because of this.
I mean, you look at all the leaders, HDFC, Axis, all of them, they're already, having digital platforms over there. With the new licenses which have been given with payment banks, mobile companies have come into it. Apple will come into it with Apple Pay. So the whole new ecosystem will evolve.
Manish, whereas India is still the engine for IT outsourcing, and numbers are showing that yes, we are getting disproportionate market share. Indian companies are getting disproportionate market share. The new confusion is that can Indian companies really move up the value chain? Is digitization actually bad news for Indian IT companies so far because they've survived on application and AMD services? The way these PE multiples have contracted looks like there is a problem in the world.
So you're right. I mean, in the public space, the legacy model of adding people and doing coding is naturally under pressure. And the leading companies there are also changing themselves and going towards robotics, artificial intelligence, and all of that. So that is a great move for them. And I think they will only keep gaining market share. So I'm not as bearish as the market saying that these should be 12, 13, 14 PE stocks.
There's an opportunity.
There is an opportunity there, and there is serious cash flow there. And these are among the most enlightened management teams in our country, and who have demonstrated real ability to scale and play on a global scale. So in a global portfolio, these stocks have to be there. As an Indian, this is really your best option in a sort of listed public space. Having said that, what you're saying is that is there opportunity for Indian IT companies in the new age? Yes, there is. It's just sad that they are not yet in the public domain. They are all happening in the private equity space. A lot of it is happening outside India because companies are setting up overseas because of ease of business or taxation or whatever. But it is fundamentally Indian people who are creating these companies.
So are we at 1999 when we were in the dot-com boom? There was a mania. The media unfortunately got pricked, but the best of the companies, they survived.
So the good news is, unlike 99, this time the whole valuation bubble is not happening in the public domain. So there are 3 or 4 large players in the world who are fueling this, and it really got triggered, I think, a lot with the Alibaba listing. So if you take Alibaba itself, which is now invested in Paytm, SoftBank, which is invested in Snapdeal, Amazon itself, which is here as Amazon India, and then Tiger, which has gone into Flipkart. These are the sort of 4 big entities putting money into technology in the private space. And the way a lot of the agreements are written is there is liquidation preference available to the private equity players. So in a downturn, it's not really the investor who will suffer the most. It may well be the entrepreneur who will get diluted a lot more. So it seems frothy. You've also got, in fact, the public market players in the US. So the Fidelities and the T. Rowe Prices have come into this domain, and they are investing into Uber and companies like that. So it's all happening, but like I said, fortunately it's not in the public markets.
So luckily, India does not have too many so-called e-commerce or the apps company. So if anything goes wrong in this part of the world, whenever it does, because one day it will dull, something will go wrong.
Someone will get hurt because all this cannot keep going on forever. In the meantime, India has a $3 billion stimulus package coming, right? Because of all these investments coming and giving goods to Indians at cheaper prices is good news for our economy.
So e-commerce is pretty much like airlines, great for consumers, but never good for investors.
I think you're brushing all e-commerce in that. It may be e-retailers are currently playing, World War II in some sense. Because the battle for US is done, the battle for China is done, it's really the battle for India is going on right now. And a couple of them will win and they'll be big winners. So if you're going to be a $4-5 trillion economy and if you're playing this space, if you have that time horizon, there is money to be made here. So none of these I'm saying are, fools who are putting their money here. The horizon is a lot longer than what it may be for a public market investor.
Let's take a quick break on the show. We've spoken about investment, we've got a sense of the market outlook, but we'll also talk about the world of PE investor. Manish shared numbers with us, which is that $15 billion of PE investment has come into Indian companies in last 1 year. That's a phenomenal number. World is changing. How quick can one adapt? More on that when we come. Welcome back in conversation with Manish Chokhani, and we are coming to you from this wonderful University of Flame. Manish, you've referred to the fact that the PE landscape is changing. A lot of our viewers, they don't have access to the PE funds, they don't have access to PE companies. So how should they prepare for this new world?
In the PE industry, we cry that a lot of us don't have access to being entrepreneurs. It's the best time in India to be an entrepreneur. Okay. There is a gold rush in India. As I said, the landscape is changing. The way we are consuming things is changing. The way we are producing things is changing. If you think of this 15 billion, it's not gone into 10 companies. Yeah. The good news is it's gone and spread across hundreds of companies. And these enterprises are sort of the new SME engines of India, as it were, who are creating the new ecosystem. A lot of people I know have been giving money to their relatives, children who have studied, come back from places like this, feel there's a new world which we can create. Some have become angel investors, nothing wrong with that. Some people have put money into domestic private equity funds. So there are opportunities if you're serious. The best one, of course, is to go and do it yourself. This is the time to build, to be part of the 2 trillion to 6 trillion journey in India. Of course. It's the time to create the new Ambanis and the new Jindals and Adanis.
I understand that, but it's, for India to go from 2 trillion to 5 trillion, tech and the startup world will play an important part. Right. But what happens to the old economy part? I'm sure they will also scale up. I'm sure they will also participate.
Think of it, when, again, we take a 20-year cycle. When I started, I think agriculture in India was 33-35% of GDP. Today it's under 15. So it remains there. It just loses its importance in terms of overall share of aggregate GDP. Similarly, industry, which we are actually very low. We are at 15 or 17. But what we classify as industry will also, I think, start changing. Because if you are producing, pizza, is it a service sector or is the kitchen an industry? I don't know. So the nature of what is industry will change. Also the way tech is putting capacity together. So for example, our car was used in the morning to go to office and now come back from office. That same car is now making 20 trips being an Uber cab. Yeah. So the capacity utilization has started going up. So I don't necessarily need to keep creating capacity for it.
So things are evolving, and that is what we must realize. Your whole core thesis is that there is excess capacity in the world. Technology and entrepreneurship will make sure that some aggregation is starting and bet on that trend as a mega trend.
Yes. I think simply we used to say in the past, whatever China can make, I don't want to be there. Because they will crash the prices, you will not make money over there. But whatever we need to consume, and it's not 20-year-old product which has got commoditized, that's the place I want to be in.
So if the consumption thesis for India is so strong, why FMCG companies are struggling with volume growth?
So when you think consumption has many forms. In your basket of consumption, FMCG may be 8 or 9% of your total basket of consumption. Think of your telecom spend, your media spend, your restaurant spend, your healthcare spend, your education spend, your travel spend. This is all consumption. There are enough ways to play all of these across. So FMCG is actually the lowest beta form of consumption in a sense. When you buy a car, it's consumption. We are at 2.6 million cars. China is at 20 million, or maybe 22 by now.
You've always argued in the past that look at mega trends and look at companies who would benefit, who are really the back end and the service providers, which is that rather than buying real estate stocks in 2000, if you bought HFC stocks, housing finance companies, you made money. If you bought home improvement companies, you really hit a jackpot. So you've identified the mega trends for us. How does one participate with these ancillary companies?
So it stays the same. I don't think there's any, I'm not likely to give you names over here, but the way to look at it, I don't think it changes.
Okay.
And you rightly said, if, finance we spoke about how it's changing and how you can participate. Real estate, which will be an important component, we've already spoken through housing finance companies, how you can participate. Technology, unfortunately, you cannot do through listed, but it's not that their story is over. They will morph, they will start having spin-outs as well, and they will start throwing out interesting companies as well. So don't lose faith over there as well easily. Pharmaceuticals, again, there will be companies which will move from chemicals to biosimilars or into genomics. There will be companies which will make the transition, some which won't be able to make the transition. So you want to see what is rate of change, because markets reward rate of change. Markets don't reward history. Markets don't reward intent. They reward where are you going to and are you likely to achieve that. And really investing is about that, and are the odds in your favor.
And whichever way the economy is moving, if interest rates are coming down, the consumer would benefit.
Yes.
If pay commission, after the pay commission, no money would be there with Indian consumers to spend. Pension or OROP will ensure that there is more money which would be doled out. So broadly, the consumption is the big picture, and consumption is where this economy is headed.
Well, you're here for the billion young Indians who are 25, 26 years of age, who will necessarily consume. And unlike our parents who waited till the end of their life and they had savings to consume, this generation starts with consumption and taking a loan to finance its consumption. So clearly, finance and consumption, IT, healthcare, these are sort of the big mega things. I don't know whether we have so much money that we need to look outside these 3 or 4 sectors.
Well, Manish, lovely campus, and what is important is that it's just a new dimension which this university is bringing about. Education cannot be just simply put in compartment. You have to have a 360-degree understanding now.
Completely holistic.
Completely. And that will work, I guess, looking at the clear example. And the one big example which we should remind everyone is Steve Jobs.
Absolutely.
Thank you for having us over.
Thanks for coming. Wonderful. Enjoyed it.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.